Pakistan is likely to launch Panda Bonds in the coming days, adding another layer to its long-running dependence on international debt markets. Today's Pakistan total external debt and liabilities stand around $130 billion, while outstanding international sovereign bonds, mainly Euro bonds and Sukuk, remain near $5 to $6 billion, even after recent repayments. This may sound manageable on paper, but the real question is different. What exactly is country borrowing for? And how will it repay? There's a little to celebrate when a structurally weak economy repeatedly borrows abroad at elevated risk premiums while exports remain stagnant. Countries normally borrow externally to build productive capacity, industries, technologies, logistics, export sectors. But in Pakistan's case, a significant portion of external financing historically went into budget support, import consumptions, debt rollovers, and sustaining state expenditure with limited long-term economic return. In simple terms, borrowing dollars to finance a system that does not generate enough dollars back. Pakistan first entered the modern international sovereign bond market in 1995 under Benazir Bhutto's government through a $150 million Euro bond issued at yields above 10% because of the country's perceived political and security risk. Interestingly, the same year, Pakistan also entered World Trade Organization framework, integrating itself into the post-Cold War liberal financial and trade order. Since then, Pakistan became progressively tied to international liquidity cycles, rating agencies, IMF programs, and investor sentiment. The modern sovereign bond system itself emerged after the collapse of Bretton Woods in the 1970s, when petrodollar recycling and financial liberalization pushed developing states toward global debt markets. Over time, these markets evolved from financing tools into mechanisms of structural dependence. Governments borrow in foreign currencies while earning revenues in weaker local currencies, exposing entire economies to exchange rate shocks, refinancing crises, and permanent rollover pressures. This is where sovereign debt becomes more than economics. It becomes strategic leverage. Most international sovereign bonds are governed not by Pakistan law, but by English or New York law, meaning disputes move outside the legal sovereignty of the borrowing state. Then bonds ownership is also opaque. Who buys these bonds from Pakistan? Major buyers historically included firms such as BlackRock, Ashmore Group, Franklin Templeton, and Gulf or Western institutional investors specializing in high-yield sovereign debt. When the government issues a bond, she initially knows the major underwriters and primary institutional buyers. But once those bonds begin trading in secondary market through systems like Euroclear or Clearstream, ownership changes continuously across jurisdictions. A Pakistani bond can move within hours between a hedge fund in London, a Gulf sovereign fund, a Singaporean bank, or an American distressed debt investor. This creates a core contradiction in modern sovereign bond system, and that is why debt burdens fall entirely on taxpayers. The ultimate ownership of the debt often remains opaque. Citizens bear austerity, inflation, and currency depreciation, yet rarely know who profits from the system. This weakens democratic accountability, allowing governments to secure external financing with limited public scrutiny and meaningful domestic consent. The case of Ukraine demonstrated how sovereign debt can become geopolitical pressure. Russia's 2013 Yankovic bond reportedly carried clauses linked to Ukraine's debt metrics, giving Moscow financial leverage during political turmoil before the Crimea crisis. Similarly, Argentina faced years of legal and financial warfare from aggressive hedge funds after default just to settle international bond repayments. In theory, sovereign bonds are just financing instruments. In practice, they create a system where default risk can collapse currencies, freeze trade finance, trigger rating downgrades, and shut countries out of liquidity markets. That is why debt servicing often becomes a state's first fiscal priority even during domestic hardship. For investors, countries like Pakistan's offer exactly what global speculative capital seeks: large populations, recurring financing needs, high yields, and geopolitical relevance that reduces the probability of complete collapse. For borrowing states, however, the danger is different. Sovereign financing gradually transforms into strategic dependency, where economic policy, fiscal choices, and even geopolitical behavior becomes increasingly shaped by external liquidity markets rather than domestic developmental priorities.